In this video, I'm going to talk about Fibonacci Retracement Indicator, and also I want to show you if it really works all the time or not. So without any further ado, let's get into it right now. Hey, what's up with you guys? This is Irfan here with the Incubator.com, and welcome to another video. In today's video, I'm going to show you exactly how to use Fibonacci Retracement Indicator and does it really work all the time or not. So before I start with the process, I would like to let you know guys that I personally don't use Fibonacci in my trading. Like in very rare cases, just to kind of double confirm my strategy or just want to see what's going to happen, but I'm not trading based on Fibonacci Retracement Indicator. But in this video, I just want to show you some examples. We're gonna go over everything together. I haven't prepared anything. I'm literally in a 5-minute time frame GPUSD. I want to see what I can see so I can actually give you some examples about Fibonacci and how people use it and where you need to use it exactly. Okay, so Fibonacci, like in a nutshell guys, let me just I'm using TradingView here. This is Fibonacci retracement in TradingView. So if you don't have TradingView guys, you can actually grab the pro version to be able to backtest it as well. You can use my link in the description. It's my affiliate link. I much appreciate it if you support this channel so I can put out more free contents for you. So this Fibonacci level right here, as you can see, if I want to draw it here, you see that it's actually looks something like this. So this is our Fibonacci retracement. So I modified it personally because I don't need any level, like every single level that this Fibonacci retracement had. I only need 50%, like 0.5, probably 0.6 and 0.7. So if you go to the setting area, you see that you can kind of change the coordinates, you can change the style, and you can change the visibility. So I personally only turn on like this area 0.5, 0.7 and 0 because it's totally enough. We mostly deal with 0.5 because between 0.5 and 0.6 is our golden zone. So let me just write it down here for you. Between 0.5 and 0.6 we have a golden zone. Okay, so this is our golden zone right here. So golden zone could be somewhere around here. This is our golden zone. So for example, when you want to draw your Fibonacci retracement, that I want to show you where to use it, you need to kind of identify the level between 0.5 and 0.6, and you need to mark it as a golden zone. So golden zone means the price reacts to that level. I show you some more examples. So for example, let me just do it right now. Let me delete everything because you kind of get confused with these candlesticks here, but let me just drag everything right here in an empty page. Okay, so between 0.6 and 0.5 and 0.6 we have a golden zone. So I'm going to draw my Fibonacci retracement here, and I'm going to draw my golden zone. Let's say this point is 0.5 and this is 0.6. This is our golden zone right here. So there are actually two scenarios that I want to give you as an example. The first scenario might be this one here. So let's say that the price is going up constantly. I'm going to use this path right here. So the price is going up and down, 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 and then right here I can clearly see that we have higher highs and higher lows, which is creating an uptrend market. So see that I'm drawing these circles here that is showing me that we have higher highs and higher lows. So in this section, I just showed you an example for a bullish market. And in this case, if you want to use your Fibonacci retracement, you need to grab it here and start from the bottom. So if the market is bullish, if you have a uptrend, like if you have an uptrend market, you need to start from the bottom. But if it's a bearish market, you got to start from the top. So this is for the bullish market. I'm going to show you an example for the bearish market. Let's say that the market is kind of coming down like this. Oh, not like that. Yeah, I mean, you know what I mean. And let me just delete this. I didn't like the shape of it, to be honest with you. We have lower lows, lower highs, lower lows, lower highs, and lower lows. So this is a bullish market, this is a bearish market. So if it's a bearish market, you need to use the Fibonacci and start drawing it from the top. which is our starting points. And for a bullish market, you need to start from the bottom of it, which is our starting point for a bullish market. And then you continue it until the tip of it. It's very, very important, guys. It's super, super important from the bottom to the top before it does any sort of correction. See that, let's say that we had the next candle, like the next trend is coming down, but you need to draw your Fibonacci retracement from here, which is the bottom, to the tip of it. The same thing for this trend here. You need to start drawing from the top, and then you need to kind of extend it to the bottom for a bullish market. Let me just put it here. They're so close to each other. Okay, see, I'm gonna start it from here, and then I continue until here, and this is going to be our golden zone here. So what does it show us exactly? First of all, we have a bearish market, so we gotta be kind of more biased towards going short. So we are not planning to go long. Let's say it's a bearish market and we should always trade according to trend. We are not gonna break the rules and, you know, good kind of buy here. There's some, you know, scenarios like order blocks, gaps, smart money concepts, trading a strategy. We are not dealing with that right now, that you could buy, but let's say that you want to short. So this golden zone is an indicator that the price might come back, hit this zone, and then go towards its original direction, which is downtrend. This is for a bearish market. For a bullish market, exactly the same thing is happening, as I said, from the top to the bottom before any correction. And I show you some real examples as well. Let me just delete this. And let's say that we drew this line. We have this golden zone here. I'm gonna draw this order block, not order block, my zone here. And here the same thing is happening. We expect the price to come back, to do a little bit of correction, hit this zone, and then go towards upside. See, we have this expectation that might be happening right here. So we expect this area to be respected so we can trade accordingly. Very, very important, guys. We expect this zone to be respected so we can trade accordingly. It doesn't matter whether it's bullish or bearish. We are trading according to trend. It's very important. And let's say even in this scenario, the market is coming back. It's kind of playing around here. It's consolidating, creating higher highs and higher lows, and boom. See, let's say that the market is gonna do something like this, and then it comes down. This is a really, really textbook definition of Fibonacci. In the real world, it's not the case. Like, it's not happening all the time, but I can show you some clear examples that you can literally take this trade and be profitable, especially when you're a scalper, guys. I'm not gonna go over 1 hour or 4 hour time frame. I'm gonna stick with 5 minutes, and then you see that how I can draw my lines and how it's respecting it. So if I want to show you an example that I wanted to show you earlier, is this one right here. See, if you zoom out, you see that we have a very strong bearish market. It's a very strong bearish trend. After breaking a couple of structures, you see the market is changing trend, and we have a really strong bullish trend exactly right here after that a strong bearish momentum or bearish trend, because it broke this structure, it broke this structure, it broke this structure, and now we have the tip of it here. So we know right now the market is trying to change a direction and be an uptrend market. But right here, the same thing will happen. We are in a bullish market. We're gonna grab our Fibonacci retracement, start from the bottom, and continue until the tip of it. So I'm gonna do the same thing. I'm gonna start from the bottom and then all the way to the top. It's very important, bottom to the top. And if I want to extend it up to here and kind of, let me just do a little bit of back test here, and we have our golden zone between 0.5 and 0.6, which is somewhere around here. So now what we're expecting is that the price hit this level, because we know that we are in an uptrend market, and then we expect the price to hit this level and then go long. So we are waiting for this zone to get tapped into, and then we take our buy position here. But let's see what happens exactly. Okay, see, once it tapped into this zone exactly at 0.5, see this shadow here, it tapped into 0.5 exactly on top of it. We have a very bullish engulfing, very strong bullish engulfing candle right after this red candle. So if I want to remove my Fibonacci indicator, you see that this zone is being respected. So in this scenario, you can do two things. So once you see this bullish engulfing candle here, which is pretty strong, you can take your position here, put your stop loss here, and put your TP right here, which is a one-to-one trade. Or you can simply remove this because you know that it's already respected, and actually identify your order blocks. Order blocks are, are where banks and institutions take their trades, so you can trade with them and be profitable and not to get stopped out in most cases. So we have a very, very good order block here, and the reason is that we have a huge gap in between. So after this red candle, we had a huge spike, and then a candle after this candle left a gap in between this order block and the candle itself. See this candle here, we have a gap in between. We have our order block here, and the gap is here. If you don't know the definition of order block, guys, I highly recommend you to watch my first video on my channel. I only talk about order blocks, gaps, smart money concept, and banks and institutions trading strategies. So you can do two things. You can either take it here and don't wait for this order block to get tapped into, or you can just simply wait for this order block to get filled in, and then you can take it. So if I want to wait for it, you see that my trade is already profitable if I want to take it right here. But let's say that I wanted to wait until this zone get tapped into, and then I take my trade. See, after this candle here, I can clearly see that it touched my zone. Now I'm gonna wait for more confirmation to go long, and it's still valid because it didn't break out of this order block. If it breaks out of this order block immediately becomes invalid, and we need to wait for the next structure or the next valid structure. Okay, so I'm gonna wait for this. Okay, so it's actually broken into our, not really, because yep, it's actually broken into our order block. So this order block immediately becomes invalid. Okay, so we're not going to deal with this order block. But the next thing that we need to kind of consider is this support level here. This support level here, which is still not broken into. So regular support and resistance levels are really dangerous because there are so many stop losses and so much liquidity that market can identify, and they know that there are so many buyers that just bought here and put their stop loss here. So banks know that, institutions know that. This is what most people have been taught, and they know that they can easily stop out every buyers here and then go towards the direction of the market. But if I want to go here, see, boom, done. Everybody got stopped out. Every single buyer got stopped out here because they put their stop loss here. You should. That's why I'm saying, guys, go for one-to-one. If you took your trade here and put your stop loss here and your TP here, which is one-to-one, your TP would have been smashed easily. But if you wanted to wait to kind of close your trade here, you should say goodbye to your trade because you just got stopped out. And now we have another bullish engulfing candle after stopping out all the buyers here. Now you can confidently take your trade. If you get stopped out one more time, that's totally fine. At least you are not trading support and resistance. You're trading based on liquidity grab, which is very, very safe. And I want to take my trade, close it here, 1 to 1.8. So let's see what happens. Boom, 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 boom. Okay, it's coming down again, and probably it's going to stop me out. Okay, so if I want to hold my trade, I probably don't hit my TP, but if I wanted to close it one-to-one, it would have been smashed. That's the beauty of one-to-one trade. That's the beauty of it. So you could take one-to-one trade here, and you can take one-to-one trade here. Two profitable trades in a row. I wanted to get more greedy and close it here, but it doesn't look good. It seems like this wants to stop me out, but let's see what it wants to do here. Yeah, see, it easily stops people out, easily. If you want to go further than that, especially when you're scalping, you should be aiming at 1-to-1, and you can easily be profitable. Okay, so that wasn't point of the Fibonacci that I wanted to use, but I just wanted to tell you that it's invalid because it kind of respected our 0.5 and 0.6 level, which is our golden zone, and now we could easily take this trade 1-to-1 and this trade 1-to-1. So what I'm saying is that Fibonacci worked in this case, but I kind of combined it with order blocks because this is what I trade based on. And I just wanted to show you guys what I exactly do. So the next example that I can show you is that right here. See, if I want to go back, you see that we have this huge downtrend, and we have this break of a structure here, which is going to change the direction of the market towards downside. We have a little bit of correction here. Right after the correction, we know that we need to grab our Fibonacci tool and draw it from here to here. Okay, so and our order block, our golden zone is going to be around here. So let's see what is going to react, if it's going to react or not. So it reacted to this level here, which is our 0. It grabbed the liquidity and now it's changing the direction. Now I'm going to remove the Fibonacci and wait for this candle here, this zone here, to see if it really works or not. That you see, as you can see, it never tapped into, and now market is going downside. It's not even touching this, it's not even getting close to this level anymore, and now it's become pointless. So this is one example for Fibonacci. The second example that I can show you is this one. I just grab my tool and then I draw it from the top to the bottom in 5 minutes, and now I wait for this golden zone to get tapped into, and then I can take my short trade. So let's see what happens with this one. See guys, let me just go back this. See, a lot of people are going to take their sell limit here and put their stop loss here. See, because they really trust Fibonacci and they want to take like a sniper entry, and they want to close their trade here 1-to-4. They're super happy, but the next thing they notice is boom, stopped out. However, if they wanted to put their order block here, which is a really obvious order block, and wait for it, they would have had higher chance of, you know, having a profitable trade. And if I want to go forward, see that this candle here, and they could probably put their sell stop here, stop loss, and their stop loss here, and their take profit here if it taps into it. And as you can see, boom, again, it didn't work out that well. But if you wanted to take it here and put your TP here and your stop loss here, then you could take it. But what I'm trying to say is that order blocks work way better than Fibonacci. I just wanted to show you both examples so you can personally compare these two strategies and see which one is actually worth it. Order block or Fibonacci, that you can get stopped out immediately. At least in order blocks, you know that you have confirmation, you have this bearish engulfing, not bearish engulfing, but this strong bearish candle. And then following that, you could instantly take your trade here and put your stop loss here and take your TP here 1 to 1.68, which is really good. So that's the definition of Fibonacci retracement, guys. I hope that you got some value from this video. If you did, please give me a thumbs up, because, you know, YouTube is going to push my videos in front of more people, and I would much appreciate it if you turn on the notification bell, so next time when I upload a video you get notified. So thank you so much, and I'm out.